Good afternoon, welcome, and thank you to everyone for joining us today for our final webinar as part of the TD Direct Investing Options Education Month. Today, our webinar is going to be all about how to manage options positions. And our featured guest to take us through that today is Laura Lau, Chief Investment Officer at Brompton Funds. Laura, a very warm welcome to you, and thank you so much for joining us today. I'd like to kick things off by first asking, how are you doing? And also tell us a little bit about yourself and what exactly you do.
Thank you, Hiren, for having me here today. I'm doing great. So I've been managing investment portfolios for over 20 years. I've been at Brompton for almost a decade, where I founded and managed the investment department, and we manage almost $2 billion in income strategies in Canadian and global equities. In fact, we're one of the biggest call writers in Canada. So I have closed-end funds, mostly in a split share structure that provides enhanced returns, and actively managed exchange-traded funds, sector and general, and they all trade on the Toronto Stock Exchange. All of our portfolios use options to generate income, reduce the volatility of our portfolios to obtain superior risk-adjusted returns. Just to show you how important generating income is for our clients. In Brompton's over 20 years of history, we've paid out over $2.8 billion in distributions. And since options is very math-centric, I have a degree in industrial engineering to help me crunch those numbers. And I have the Chartered Financial Analyst designation, the Derivatives Market Specialist designation, and I'm licensed to trade options and futures.
Wow, Laura, thank you so much for that introduction. I must say, with all of your credentials, what a privilege it is for me to be sitting across from you today and going to be able to pick your brain as a portfolio manager to get to know a little bit about how you run your fund. But more importantly for today, how do you manage those option positions as well? Now, you mentioned that selling options and deriving income is a big part of that strategy. And so today, we're going to be looking specifically at covered calls and cash secured puts, as they do play a big role on your strategy, as I understand. And we'll be talking about that throughout today's session. I'd like to begin first with covered calls, though, a strategy that a lot of option traders, in fact, employ as part of their trading practice. But so if you could tell us a little bit from your perspective, how does that strategy work and how do you use it in your fund?
Great. So a covered call, basically you own a stock and then you sell or write a call option. So you're obligated to sell a stock at a certain strike price within the expiration time period. So let's just run through a quick example. So if you already own a stock, or if you buy at $100 and you sell one call option, every call option gives the seller the obligation to sell 100 shares of stock at a strike price. We'll use $100 in the example, and within the expiration time period, again, we'll use 30 days. And in return, you get a $5 premium in exchange. So $5 times 100 shares, that's $500 that's deposited into your account. So in this example, the stock is trading at $100 and a strike price of $100, which in options terms is at the money. If you want to have capital gains, you can write at a higher strike price, but you won't get that $5 premium. You'll get a lower premium. So you have to balance what premium you're going to get with the opportunity cost of losing that upside. And there is a point where the strike price is so high that you don't get any premium at all. So we have a chart of, how a payoff diagram would look for a covered call. So on, the horizontal x-axis is the stock price, and the y-axis is the profit or loss. So you can see the red line is basically if you own the stock, and the payoff diagram for the short call, which is in green, which, as I said, is obligation to sell the call at a strike price of $100, and you get a $5 premium. And this is risky if it's not covered, because in theory, stock prices can go up to infinity. If you're uncovered, that means you don't own the stock, and you'll have to buy the stock in the market at whatever price it's trading at. So if you sell a covered call, you own the stock in red, short the call in green. And if you add those two charts together, you get that blue covered call. So the stock price is trading $100, and we write the call at a strike price of 100. So as I said, it's at the money. You get paid a $5 premium in your account, or a 5% premium. So you reduce that break even price by that premium. So your break even price is $95. So you've capped your upside at $100 uh, for that premium of $5. So, which means you've capped it at $105. So it's really best when you're moderately bullish, bearish, or you think that the market's temporarily weak. And that prima is that buffer that will help you reduce your cost base in case that share price does drop. At Brompton, we tend to layer options with different strikes and expiration dates. And usually we write a maximum of 50% unless we plan to sell that position. And in that case, we can write 100% of that position, but we never write on the entire portfolio. And before you execute a trade, you can calculate your payoffs and returns in different scenarios. So if you think the stock could be in the money, out the money, and you can use a payoff diagram like this to determine what your upside, downside is and what your risk and reward is.
That's wonderful, Laura. Thank you so much for those insights. I do really like that strategy. I know there's a little bit of a risk with the upside, capping the upside, but I did want to just for a moment move on to the next strategy that we also talked about, and that was the cash secured puts. Now, with that, if you could first please explain and shed some light on what it is and how do you employ that as part of your trading practice?
Thanks, Hiren. So we'll use, the example for covered puts, and the numbers will be the same as we did for the covered calls. So strike price $100, so you're obligated to buy a stock at $100 and within 30 days. So you get the put price, which is $5, so 5 times 100 shares, you get a $500 premium deposited into your account. And in this case, you need cash or margin to buy that stock in case it is exercised. So the cash or margin required is the strike price, which is $100 times 100 shares, subtracted by the premium earned, which is $9,500. And if the option is exercised, your effective cost will be $9,500 divided by 100, which is $95, opposed to $100 if you had just bought that stock outright.
Now, might I add here for our viewers, for clients of TD, the cash secured put strategy, in fact, doesn't require the full cash assignment value on that option. It just does require the minimum margin requirement of that security. And as such, this security or this type of trade, I should say, rather, can only be traded in a margin trading account with us. And it does require the highest options approval level that we have, which is level 4, as it is regarded as an uncovered strategy. And Laura, I'll hand it back to you again. I know you have a payoff diagram to show us well, so could you take us through that on the cash secured put, please?
Okay, great, Hiren. So the payoff diagram for the cash covered put, you can see again the stock is a red line, and return on cash would be 0, and the covered put would be in blue. So you can see the payoff looks very similar to the covered call. So if the stock drops, you get the $5, which is more than if you'd owned the stock. In return, your upside's capped. So you sell if you believe the stock will drop in this time period, so you can buy at a lower price. So it is a slightly bearish strategy. And if the stock takes off, you're just going to hold cash. So you've really lost the opportunity cost and lost your chance to buy it at a discount. So one of the big differences with the covered call is, since you don't own the stock, you don't get paid any of the dividends on the stock, versus a covered call. Since you did own the stock, you do get paid those dividends. You can also see that the payoff profile looks very similar to the covered call, and your break even is $95. So again, this lowers the break even entry price of the stock. So the premium is a buffer that helps reduce your cost base in case the share price does drop. And the timing is more important than a covered call, because in general, the market is biased to go up because of inflation. And in theory, covered calls and the covered puts with the same time and maturity and strike price will have the exact same payoff diagram. But in practice, you'll almost always get paid a higher premium for a put than a call. And the reason is people are risk adverse. They don't want to lose money. So you'll pay more for downside protection because that is insurance.
Perfect, Laura. That's fantastic. I'm really soaking up so much over here, a lot that I've, being in the field that I'm learning from you. I am curious to know, and I think a lot of us as traders want to know this as well. because you manage such a big fund, what are some of the goals you have in mind before you put on these strategies, such as a cover call and a cash secured put?
So before you enter a trade, you should really think about why are you entering this trade? What's the strategy? What's your goal? So the most common, I would say, it would be the first one, which is generating income. So you get option premiums deposited in your account and you can supplement income generated on your portfolio. It's almost like creating a synthetic dividend on any of your stocks. So Brompton generates income for our clients. So most of Brompton's products do pay a distribution for our clients, and we do use that to supplement the dividend income for our investment portfolios. The other way we use it is as a sell discipline. So you can write a covered call at a strike price that you're willing to sell at a predetermined level. It can be greater than the current price, so you can have opportunity for capital gains, or you can also write it in the money. And that premium will reflect the intrinsic value, which is really the amount that's in the money plus the time value. So at Brompton, we do use this to sell stocks when it reaches our target price, or we want to sell and buy something else to reposition our portfolios. You can also use this for a buy discipline when you can write a cash cover put to buy at a predetermined strike price below the market. And if you believe the price will drop, and the effective price will be lowered by the premium if you're assigned. Uh, Harvesting volatility is another thing you can use. So if Brompton believes the volatility price in the option premiums is greater than what will actually be realized in the market. So this is a little more complicated, so I'll explain this. So one good way to do it is to watch the VIX, which is the Chicago Board Options Exchange Volatility Index, which is the expected volatility of the S&P 500 index, or many people call it the fear index. We also look at the implied volatility stock if it's higher than normal or higher than the historic volatility of the individual stock. So if you believe that you're getting paid more for this option because of the volatility, then it's a good time to write options. So the higher the volatility, the greater the premium you'll earn. So we use this to harvest volatility. We do regularly monitor the market, the stock volatility versus the historical. But one thing to remember is the VIX and the volatility on stocks tend to be higher when stocks drop or the market drops. So if the VIX is abnormally high, like over 40, the returns actually tend to be very good after. Like one good example would be March 2020, just last year. So we do talk about this and other interesting investment topics in our Brompton Insights series that is available on our website at bromptongroup.com. So another strategy would be to reduce volatility. So the premiums generated do reduce the volatility of your returns. So Brompton uses this to improve our returns and reduce the risk to really get better risk-adjusted returns. So the last one is systematic versus tactical. So systematic, what some institutional managers do is write a set proportion of the portfolio, and sometimes they do a certain, amount in the money, out of the money, and they roll every month, or some of them just write enough to generate a certain premium every month. So they write no matter what. At Brompton, we're a little different. We're tactical. So we only write when we think that the stock market or stock is weak, range bound, or has, really run up too much, and when we think we get paid enough. So the volatility is typically low when a stock is going straight up. So really you're not getting paid much to give up that upside. So we believe it's better to write when it's the market or the stock is range bound, or to write on more volatile stocks because you get paid more premium that way. So just in summary, I think that before you go into a trade, it's really important to know what your goal and strategy is because it really helps determine how you can trade your options going forward.
That's brilliant, Laura. And I know for a lot of option traders, volatility is a big measure that they look at, and along with the VIX. And for our audience who are clients of TD Direct Investing, those pieces of data sets are also readily available to you on WebBroker. For the first one, when we're looking at volatility or implied volatility, you can bring up the particular securities options chain on WebBroker. And when that loads up, you're able to go to the analytics section and pull up the volatility measures for those particular expiries you're looking at. As far as it goes with the VIX index, this is simply doing a search just as you would do a search for any other stock on our platform. You would go into the symbol search bar, and type in .vix, and this will bring up the VIX index values there for you. So definitely helpful for those who are looking to place these kind of option strategies in the trade. Laura, I wanted to just move on a little bit from that. So now we've got to a point where we've understood the goal behind the strategy. But before we enter the trade now, are there any considerations that you make when you're putting this trade on? And if so, could you take us through some of those considerations you have? Sort of a checklist, if you will.
Okay, great. Thank you, Hiren. So before we enter a trade, we actually, this is what we go through. We look at the market. Do we believe the market's going to go up or down? So there's some, inputs into that decision-making process. So really, where are we in the cycle? The market tends to go in cycles because the economy goes into cycles, and they're typically also driven by business cycles, which are also follow the US presidential cycle. So right now we believe we're in the early stages of a bull market. So that's one thing you have to determine: early, late, middle. And being in the early stage of a bull market, usually the drawdowns are less than 10%. We're also in the second year of a bull market. So if you actually go back to about the 1930s, and we've gone through the bull markets, there have been about 15 bull markets since the 1930s. 14 out of the 15 of them have generated positive returns in the second year. The only time that hasn't occurred was in the 1930s in the Great Depression. So we do believe that in general, the market direction is up. And then you also have to look at, other things like the central banks. The policy, is it accommodative? Is it light, loosening, or tightening? Interest rates, are they going up or down? And, in the last 10 years, we've had quantitative easing. So currently rates are very low. We do expect rates to increase, but they're still very accommodative. And one thing you should never forget is the number one rule investing is don't fight the Fed. And the Fed right now is very accommodating. The other thing we do look at is, government policy. Right now, we're in a very unusual time with extreme deficit spending. Do we think taxes are going up or down? It looks like the U.S. is probably going up. And, the other thing, especially in the U.S., is can the government get anything done? So right now, we have a president and Congress by the thinnest of margins. The Senate is 50-50 with the Vice President Harris the deciding vote. So it's not going to be easy to get anything done. And in general, that's what the market likes. The market likes when there's no big government policy changes. So it tends to behave the best when there's a mix of in the House, Senate, and President. And then we also look at the economic and earnings outlook. Things like expected GDP growth. We do expect high GDP growth coming off of COVID, and there's a lot of savings pent up that is just really wants to be spent. So it's impacted by, as a lot of the things I talked about earlier, the fiscal, monetary, government policy, tax policy. And then, look at the valuations. Is the market cheap, expensive, relative to history, the fundamentals, and this point in the cycle? And a lot of people think, yes, the market looks expensive, but relative to this point in the cycle coming out of recession is actually reasonable. Seasonality. A lot of people say selling may go away. And in terms of volatility, it is actually typically lower over December, over those Christmas holidays, and also the volatility tends to be lower over the summer, except for last year. Last year was a special case where the volatility was very high. And in terms of trend analysis, we do look at technical analysis, things like recent performance. If the stock market's been very strong, it's been a big run up, maybe there's a higher probability of it checking back a bit. If there's been a sell off, because we do believe if this is a bull market, it's a good chance that the market will bounce. So it is important to look at support, resistance levels, and volumes. So that's in terms of the market. And then in terms of individual stocks, we think you should do similar analysis because certain sectors of stocks outperform, underperform, depending where we are in the cycle. So what I mean by that is, like, say, sectors. Different sectors have different volatilities. So we manage a number of sector funds. So for instance, technology, we manage the Brompton Tech Leaders Income ETF or TLF. Not surprisingly, tech has higher volatility. And then healthcare, we also manage healthcare ETF, Brompton Global Healthcare ETF, HIG. It actually has surprisingly high volatility, except outside of pharmaceuticals. And then in terms of financials, we manage a number of sector funds there. The Brompton North American Financials BFIN. We have some split shares as well, SBC, LCS, LBS, and they all have lower volatility usually than the market, partly due to the higher dividend. And some sectors are also less volatile, like utilities, consumer staples, and real estate. So I think you really should have a fundamental view on a stock before you decide to employ these strategies. So things like valuation. What price are you willing to sell at? If you write a call on a stock, you have to expect it could be called away, and you have to think about how comfortable are you in being assigned, and what's the tax situation if it's in a taxable account. And you may actually want it to be assigned for buy or sell discipline. You also have to balance those capital gains versus what premium you earn. In general, about a 3% out of the money level is a good starting point for a good balance of capital gains and premium you collect. And you adjust depending on the sector in the stock. As I said before, more volatile sectors like tech, you can usually write 5% out of the money and still get a good premium. And after a sell-off, volatility is often elevated. So when a stock is trending upwards, often the volatility is lower. So for on puts, do you want to buy it? Do you want to buy this on a pullback? What if there is no pullback? You might miss out on that upside. So it's really important for investors to decide what your strategy and goals are before you start. And you also weight the probability depending on how much out of the money, the timed expiry, how close it is to strike it is. So basically, longer time to expiry, higher probability will be exercised. Closer to the strike price, higher probability the option will be exercised. So, if it's closer in the money or at the money, as I said, higher chance of being called away, but your premium is higher. We've had options that we've written 10% out of the money actually get expire in the money. So you really have to manage your expectations going to that trade. If that stock goes up 10%, are you happy? If you run 5% out of the money option and lose that extra 5%, how much regret are you going to have? So you have to make these calculated bets. Is the premium enough to sell that call? And if you think the stock will go up above that strike, well, don't write it then. So another one thing to look at would be catalysts. So things, like more obvious things like earnings, investor days for healthcare drug trials, lawsuits. And one thing I think people don't really think about is what about the competitors? What do the competitors do? So for instance, we've had Home Depot report and then it goes up. Lowe's, its competitor, moves up as well. So you have to be cognizant. You can't just monitor your stock. You have to monitor the competitors as well. And if a stock runs up into earnings, we've seen even if earnings surprise to the upside, it still may sell off because the expectations were higher. So, and same thing happens is sometimes the positive earnings surprises are not baked in the stock. So the volatility typically will be elevated around earnings and other catalysts so that you will get a higher premium. And you also have to look at the volatility. I talked a bit about, historical versus implied volatility by that option price. And again, trend analysis. We talked a bit before, important support and resistance levels. So in choosing an expiration, one good way to think about it is this time decay chart. So what it shows is, on the horizontal x-axis, the number of days to expiration, and the vertical y-axis is the time value, which is time value you're paid. So basically, when you're selling an option, you're selling time and you're selling volatility, and it is a depreciating asset. And that path is different depending if the option's in, out, or at the money. But always at the end of expiration day, that time value is 0. And you get paid the most if the option's about at the money. And it does that decay does accelerate as you approach expiration. Therefore, the shorter the option, the more time value there is. And that's why we typically write on options that expire within 30 days, max 2 months. And some of the more liquid options like Apple actually have weekly options. And there's typically more liquidity strikes at monthly option expiration. So we typically do roll options when there's less time value of money on or close to that expiration day.
Laura, that was brilliant. I mean, there's a lot of points in there that a lot of viewers and traders may have not thought about when they're implementing their trading practice. I'm sure we'll take that away. I did want to just kind of focus and narrow in on one thing you mentioned towards the end there, and I think that's going to be very important for a lot of options traders, and that's evaluating positions from the aspect of them being in the money, out of the money, or perhaps at the money. Now, since a lot of these strategies that you employ are about selling options, we know that we can get assigned at any time. But in particular, could you walk us through an option expiration and how do you manage that process with your fund?
Okay, so let's start with, the easy one. If it expires out of the money, you can do nothing and it'll expire automatically, or you can write a new option. So on a call, you might roll down to a lower strike, and with a put, you roll up to a higher strike. You can wait until after expiration, and you don't have to roll. You can just write a new one. Um, and what you should do is you should look at the different strikes available on the nearest expiration versus the next month. And the reason is when, and we go to the newest month, we often have new expirations opening up. Sorry, with new strikes. So, for instance, you might see the next um, 2 months out have strikes maybe every $10, but the one that's expiring will have it 250. So, as I said, these new strikes often open up, and you may prefer to write at those strikes. So you might want to wait until after option expiry, because the next business day you'll have a whole host of new options that you can write at. And out of the money options, um, they can be exercised. We've had it happen. It's rare, but it does happen. And due to the prevalence of all these exchange traded funds such as Brompton, sometimes up to a quarter of the equity trades actually trade at the close. So sometimes you think an option will close out of the money, in the last minute or after market it trades in the money and it gets exercised. If you are concerned about this, you can close it out of the money option. There'll be a premium to pay, especially if it is, just at the money. The more complicated one is, what if it's in the money? So, option one, you do nothing, you let it expire, and you get assigned. Um, if it's in the money, your counterparty will usually choose to exercise your option, and you'll sell it at your strike price. We sometimes have gotten options that are in the money that have not been assigned as well. But for covered calls, you'll sell your stock at strike and you'll get cash. The second option is you close it, and this is probably what you do if you do expect the stock to continue going up, or as I said, you might want to close it and wait until new strikes open up. So option 3 would be the roll the option. So that's 2 transactions. So you close the in the money option and the open and sell another option. If you expect the stock to come back, or you get paid enough premium, you can open another strike.
Perfect. Thank you so much for that, Laura. And for our audience, as we had alluded to earlier, assignments can happen at any time when you're short an option. Now, typically there is going to be greater risk for options that are in the money. Now, if an option does get assigned, it is going to be an automatic process at direct investing, and the commission for an assignment for us is going to be $15 flat per assignment. Now, assignments typically take place after market close, and the accounts will generally get allocated or deallocated, the cash or shares, depending on the strategy you have, the next business day before market opens. Now, for any options that are considered to be in the money by 1 cent or more on expiration day at close that have not been closed out, those are going to be subject to automatic assignment or exercise, provided the account does have the necessary cash or buying power or shares to support the assignment. Now, in the event your account does not have that, then the requirement will be that those options do need to be closed or rolled out by 3 p.m. Eastern Time. Now, going back to our conversation, Laura, that's obviously going to be a lot to take care of, or a lot to keep a track of, especially if you're writing multiple options across the portfolio. And so how do you go about monitoring those positions across, through the life cycle of the option? And how often should we be monitoring them as well?
Okay, so we have a lot of tools at our disposal. We have Bloomberg, spreadsheets, trading system to help us identify in the money, out of the money options. And these, trading systems are very, yeah, expensive, but they are very efficient. So if your options are fully covered, you don't have to monitor them every day. We at Brompton do, but when we monitor them, we do check if they're in the money, out of the money. And the more volatile the market, I would, strongly suggest you increase the frequency you monitor. And you also want to monitor more if you don't want those early assignments. Assignments typically occur when they're deeper in the money and when there isn't as much time value left on the option and they're closer to expiry. So on expiration day, you should always monitor them. And depending on how close they're in the money, you should monitor them at least at market open and close to the end of the day. And if it's the end of the day, you got to make sure you have enough time to execute those options.
Great. Now, Laura, with that being said, what is Brompton's preference when it comes to options that do go in the money?
So, due to our fund's tax situation, we do prefer options are not assigned. So, for any tax advice, please, seek professional advice.
Okay. Now, I'll add to that as well as for any of our direct investing clients, you can employ the covered call strategy through a registered account, such as a RSP or TFSA, which does provide certain tax benefits to it, such as tax deferment or tax exemption. Now, for strategies where you're doing a cash secured put or doing a covered call through a non-registered account, such as a margin trading account, that will potentially create a tax liability since it is a non-registered account. And in that event, you do want to make sure you do consult with a tax professional to find out the specifics on your situation and how it will impact your taxes. So, Laura, thanks for sharing that with us. I'm going to just keep picking on this idea of assignment happening and we're going to talk about expiration day because, well, we know on expiration day it can happen, but it can happen earlier than that, and that could potentially derail the strategy that we have in place. So, when does early assignment typically tend to happen?
So, on call options, they usually, exercise early if they're in the money and if a dividend is being paid. So, the dividend is paid to the shareholder of record on record date. So, if you don't want early exercise, you should roll those options ahead of time, usually to higher strike, and depending on how much time value is left, it's usually, the next month expiry. It also frequently happens when you're deep in the money and close to expiration when there isn't a lot of time value left. That's usually, the week of expiry.
All right. Now, I know we don't have a lot of control when it comes to assignment, and if this happens where we do get assigned, is there a way that we can rectify or fix that situation for the strategy that we started with?
So one thing to remember is if, your option's been assigned, the trade date was the previous business date. And since options settle trade date plus one, that it settles the date you get the notification. That's and that means that the trade's already been executed. You can't reverse that trade. So the only way to prevent that is to be proactive and roll that early. And you have to go back to your strategy. Maybe you wanted to be assigned. And depending on your tax situation, in the case of the call, you can buy that stock back. In the case of put, you can sell the stock.
Now, with that being said as well, I know there's a lot of emotions invested when you do trading. And there's this element of what we call FOMO, the fear of missing out. So if we get this early assignment and we suddenly realize, oh, there's a lot of upside still there and we've missed this opportunity, how do you reconcile those emotions? How do you reconcile those sentiments of dealing with that?
So before you enter the trade, you have to realize this is a real possibility. And it's higher chance assigned if it is deeper in the money or if there's a dividend payment. And if you want, you can buy the stock back or a similar stock, but really don't let emotions color your view.
Okay. Now, with that situation that's unfolding where a covered call does get assigned to us and our shares do get called away, um, do you then go ahead and buy that stock or and sell the call to reestablish that position?
So you really should go back to your strategy. Did you want it to be assigned? If the calls options are assigned, you have a choice of, one, buying the stock back, and really depends on your fundamental view. We typically don't because at Brompton because of the tax consequences. Again, get professional tax advice. If you buy back, you can also
Mhm.
write call options again. Typically, there's not a lot of time value left, so you probably want to write the next expiry. Second option is you sell puts. If you have enough cash
Mhm.
for margin, and three, you buy another stock. Again, all this depends on your tax situation, your investment strategy, especially if you originally wanted to sell at this price. But remember, when you enter a trade, you
Mhm.
should be prepared to lose out on your upside. And as I said, you can buy a similar stock. Like if you got called away on Home Depot, you can buy Lowe's instead, or it can be
Mhm.
something completely different. If your put options have been assigned, you can just buy the stock at your strike price. So make sure you have enough money in the account.
Yeah, absolutely. And that's a good point you raised, actually, Laura. For a lot of our clients, I just wanted to point out that due to the assignments that can take place at any time, you do want to make sure that you are able to meet the obligations of that assignment. Usually, you won't know that an assignment has taken place until the next day when your account has been, allocated the cash or you've got shares put in or taken out from your account. Now, this can potentially cause, especially when you're dealing with a margin account, for the account to go into a margin call due to an increased volatility there after the assignment on the underlying security. Now, in the event that does happen, you do have to make sure you satisfy the margin call before you're able to put on any new strategy or new trades as part of that assignment. So just keep that in mind. And Laura, I did want to just talk about the idea of rolling options because we talked about that a bit already. Um, this is going to be a key element to managing option positions, especially when they get closer to the money. And it's a way of reestablishing our strategy or even allowing us to buy more time. So could you please tell us typically when would you employ the role? When would you typically do the option role as part of your strategy?
So a quick review, a roll is two transactions. You close the existing option and you open a new one. We typically wait until option expiry day or close to option expiry since there's less time value. And time value decays very
Mhm.
rapidly, especially on expiration day. And it also depends on the liquidity of the option stock. As we explained earlier, we roll early if it's in the money or dividends are being paid, and sometimes we roll early if it's deep in the money. We also roll or close early if we think the stock is going to continue to go up, especially this sometimes happens on a technical breakout.
Mhm. Well, thank you, Laura. This, in fact, concludes our presentation for the webinar today. Thank you once again, Laura, so much for your insights, your professional insights, I should say, and the inner workings of how a professionally managed fund does get managed and run, and especially when it comes to options management. I know, like myself, probably a lot of our viewers do have learned a great deal and probably do have a lot of questions to ask as well. So at this point, we're now going to move on to our question and answer segment.